Welcome, everybody, to another episode of the Moving Markets Podcast. It is the 26th of February, 2024. The market's been closed for a couple of hours on this Monday afternoon. Kind of a little bit of a blasé day in the market. The Dow Jones Industrial Average spent a lot of time in the green and then sold off and was negative at the end of the day. But none of the damage on any of the three indexes was too bad. It was kind of a somewhat flat day. Might get a little bit more of that throughout this week. We'll talk a little bit about that, some things that are upcoming. I'm going to do something for those of you that are not Safe Option Strategies members. I'm going to share with you the trade that we just sent out to all of our subscribers and paid members of the program. Every once in a while, I'm going to throw you a bone, see if I can get you interested. Make sure you take time to check us out on sostrades.com. You can be a participant in every one of these trades that we send out. This year, we are not even to the end of February. We are almost at 25% return on the year. That is better than any of the indexes have done. And in spite of a good, strong start to the year, a couple little pullbacks have kept it from being any higher than that. And we're on pace to have a really incredible year this year, being up almost 25% in the first 2 months. We have not sent out a trade to the members of our program yet that has not been profitable. So we've closed everything in the green so far this year, and we expect that record to continue. Make sure you, like I said, check us out at sostrades.com. Subscribe to our YouTube channel, like us, follow us however you can on whatever platform you're watching this on. It's going to be kind of a short presentation today. I'm going to spend most of the time focusing on the new trade that we sent out and then just talk a little bit about what to expect for the rest of this week. Enjoy the rest of the presentation. Welcome, everybody, to the Moving Markets Podcast. This is Jeffrey Dunyan, CEO and founder of Safe Option Strategies. Glad to have you here on a Monday. It is February the 26th. As I'm recording this, the U.S. market has actually been closed now for about 5 hours, and I'll tell you why that is the case. I did a recording earlier today, about 30 minutes after the market had closed, and thank heavens I had someone go over it for me prior to posting this online and sending it out. Last week, we had a little faux pas where we lost audio, and I still to this day don't know why that happened, but we missed a podcast last week because we were completely without audio. Didn't have the same thing happen, but we lost audio at one point during the presentation, and there was a big gap, about a 3-4 minute gap in a relatively short presentation, so that made up a big enough chunk of it. But I decided, I tried to do some editing and some clipping and do some stuff a little bit different. And ultimately, I decided it was much easier to simply re-record. So you're getting this a little bit late. I understand that. It's, for some of you out on the East Coast, it is already well into your evening, and this is barely going out. But let's start out by talking about the new trade that we sent out. And again, this came out to you probably a good 5 hours ago. For the new trade this week, last week, if you remember, we sent out an in-the-money bull call spread on Walmart, and the trade did not get filled. And primarily because we had a limit order that we were trying to stick with. Walmart was up a little bit the next morning, and so the option prices were immediately changing, and our fairly aggressive fill order just simply would not fill. I left that trade open for the entire day. We even tried it a second day, still didn't get it to fill. So at the end of the week, we sent out a trade for an in-the-money bull call on NVIDIA, and we were successful in getting that filled. Some of us at a 322 expiration date, others at a 328 expiration date. Or I might be wrong on that. It might have been 315 and 322. Anyway, we since we missed out on Walmart last week with the in-the-money bull call, I decided to do a Walmart leap diagonal spread this week. As if you follow Walmart at all, you're well aware that just a few days ago, the stock was trading at pretty close to 180 a share. Walmart did a 3-for-1 stock split. So whatever position you had, if you had any options, if you had any stock in Walmart, it basically tripled over the weekend, but the price of it went down, 2/3. So you still had the net same value in your portfolio, just spread out a lot amongst a lot more shares. The trade we chose to put out this week is a 117 2025. So the January monthly expiration for next year, January 2025, the 60 strike, which is just a little bit out of the money at today's close. And then we coupled that with a 419, April 19th, 2024, 65 strike short call. All really good things about this trade. Number one, this trade has the ability to be an incredibly profitable trade. Let me pull in a stock chart real quick of Walmart here for those of you that are actually watching this via a video, and show you a couple of things that we expect will happen with this trade. Nice thing about a diagonal spread like this is you can profit with several different outcomes of stock movement. It doesn't have to be a steady, strong bullish move. It doesn't have to be a flat move. It doesn't have to be a bearish move. You can get any of the three and potentially still profit. So let's go through that a little bit real quickly. To start out with, I'm going to put a circle out here, right on the margin here, that represents that leap long call. Okay, it's obviously it's way out in time. It's out in January 2025, but I'm going to put it right there. And then at the 65 strike, which is off the chart here, I'm going to put, we're going to pretend this is the April short call. The difference between the strike prices of these two options is $5. So if stock were to skyrocket up, and prior to the expiration date of this option, this 419 short call, if the stock were to go over $65 a share and we were at risk of possibly being called away at $65 a share, that's okay. We're not going to be real strong profitable, but we would be profitable in that scenario because we've got a 470 limit debit order. The most we're going to pay for this trade is 470. So if we got called away at 65 and we could exercise our right to buy the stock for $60 a share, we would make that $5 difference. There's $5 between the 60 strike and the 65 strike, and we would profit all of that $5 minus the 470 that we would take in on the trade, or excuse me, that we spent to be in the trade. So it would be $5 that we would make minus the 470 we'd spent. So that's only 30 cents per share. But what's nice about that is we're guaranteed to be profitable. We don't have to worry about getting called away and somehow having that be a bad thing. Now, the hope so that's one way we could profit. We could profit if there was a very, very strong bullish move that took us right up over $65 a share. And let's be honest, 30 cents a share divided by 470 that we would spend is almost 6.4%. It's not a stellar return. It's better than a CD is paying right now. It's better than a 6-month or a 1 year or a 10-year treasury. It's not a bad profit for a trade that we would be in for about a month and a half if that were to happen. And if we got called away early, then obviously we're in it for less than a month and a half. So that's not a bad deal in and of itself. The way that we're most likely to profit in this spread, let me get rid of the marks that I put on here. The way we are most likely to profit in this spread is that as the stock price moves up past 60 and eventually towards 65, which I fully expect is going to happen over the course of the next 2 to 3 weeks. As that happens and we get this upward movement, the long call should go up in value faster than the short call. Right now, at this moment in time, both are made up 100% of extrinsic value. But as soon as we go over $60 a share, there will become some intrinsic value in the 60 strike option and still only be extrinsic value in the 65 strike option until it goes in the money. And time decay will work in our favor. While both options will experience time decay, the time decay on the nearer term option will begin to accelerate and become faster and faster and faster, to where even if this long option simply maintained its value, the amount of money we pay for the long option, if all that did was stay the same between now and the middle of April, but this option ended up losing most of its value, we become profitable in the trade. So that's another way we can profit. Now, believe it or not, we can also profit in a flat to somewhat bearish move. Now, this is not the preferred move, and this might include having to make an adjustment, but we can actually profit even if the stock were to pull back a little bit. Again, this option would lose value much faster than this option. And if there was a pullback far enough to give us like a technical crossover on the 5 and 20-day moving average right here, a technical crossover on the RSI, technical crossovers on the MACD, we can treat this week long option, just like stock ownership, roll our short call out, maybe roll it down a little bit, maybe leave it at the same strike price, and use the additional credit to buy a long put option, maybe only a month or two out, maybe only a couple of weeks out. But if we were to get a technical crossover to the downside and add a long put option, we would actually be protected and possibly even profitable if the stock were to pull back and come back to, its lowest level of support in the last 3 to 6 months. So, number of ways we can profit on this trade. I would not pay right now more than $470 to get into this trade. If you're not in it already, hopefully you have your order set up already. And then I don't think it's greedy to target upwards of a 35% return on this trade, because I forgot one last way we can profit. We could allow this option to expire worthless. Let's say the stock sort of flattened out somewhere between $60 and $65 a share. It just kind of got into a range like this, in like maybe a $5 range. If we had something like that happening for 4, 5, 6 weeks, we could roll this option out. We could roll it down a little bit. We could move it around. We could possibly let it expire and then add a new short option in the next month of expiration at the same strike price. And we could do that a number of times until we got that big, strong bullish movement that we want. Each time we do that, we would lower the average cost of the trade. The cost basis would go down, and that would be a profitable thing as well. So I love this trade. Number of different ways we can profit in this trade. I expect this to be a little bit longer term trade. A lot of spread trades that we get into, we try to get in and get out within 2 to 3 weeks. I'm okay being in this trade for 4, 5, 6, maybe 7 weeks, maybe a few months. If it meant being really profitable in the trade, and if it was really helping our portfolio along, it would not bother me at all to see this be a longer term trade. Okay, with that said, I'm not going to spend a lot of time recapping what the market did. The Dow Jones Industrial Average was up for a large portion of the day. The NASDAQ was up for a large portion of the day. The S&P was pretty flat, but kind of back and forth in up and down territory. But after a little dip around 130, it came back up to being kind of flat and then sold off in that closing 10, 15 minutes of trading. 16/100%. That's really a relatively flat day. There was not a lot going on today in the way of economic news. The economic calendar, durable goods, FH, FA, house pricing index, consumer confidence. Those are all out tomorrow. Today, the new home sales report just wasn't enough to move the needle in a really big way. The PCE report on Thursday is going to be the real true market mover this week. I expect things are going to remain a little bit to the flat side if we don't have an unexpected news story. That can happen on any given day. Any time, any day, you could have something geopolitical happen. You could have something in U.S. politics happen. You could have a bankruptcy declared by a company that no one ever thought would go out of business. So at any time, you can have something like that happen. But barring a very unexpected news event, I expect the markets are going to be kind of flat this week until we actually get to Thursday morning and get that PCE report. When we get that PCE report, another indicator that inflation is ticking upwards a little bit, probably the entire market comes down and finishes negative to at best maybe flat for the week. If the report is not as bad as people think, or if it shows a little bit of good news in the way of easing inflation, you could have a real rally on Thursday and Friday. My bet is that it's going to paint the same picture that PPI and CPI painted, that you're probably going to get a little bit of a downward trend because of higher inflation numbers than what are hoped for. And if that ends up being the case, I think you got to really be prepared to ride out a little bit of a storm on Thursday and Friday. That's my prediction for the week. I told you this would be a little bit of a short presentation. Not a lot more to talk about for today, but there'll be plenty to talk about tomorrow and as we move later into the week. So thanks once again for listening, and we'll see you back here tomorrow. Thanks, everyone. Bye-bye.